Okay, good evening everyone. Welcome to the 7:30 session on building a trading plan. It is good of you. I don't think there's anything on TV tonight. Master Kitchen maybe, but or My Kitchen Rules, so this will be a little bit more interesting, hopefully. All right, we'll get ourselves underway straight away. Got my recording on there. I will do a bit of talking, and then if there's any questions, we'll get those addressed. If I don't get to your question, I'll certainly get to it privately and reply to you, but we'll get ourselves underway right now. The disclaimer: this is educational material prepared for general guidance only. It does not constitute financial product advice, nor does it take into account investment objectives, financial situation, or particular needs. You must contact a licensed advisor before acting on any information you may see or hear. For those that don't know me, this is my, I guess, CV you call it. I hold the Australian Diploma in Technical Analysis, received that back in 2003. I'm certified with the International Federation of Technical Analysts as a financial technician, so CFDs. I spent 7 years on the broking desk with Macquarie and RBS Morgan's Wilson HTM. I hold ADA 1 and 2 compliance in derivatives. I'm president of the Sydney Australian Technical Analysts Association, and I'm a member of the Professional Technical Analysts Association, and I am the analyst at First Prudential Markets in Sydney in Bridge Street. Tonight we're going to have a talk about basic price action and building a trading plan around basic price action and what we see in the market. The reason that we do this webinar, the plain and simple reason that we do this webinar is for people who want to add on to their existing trading plan or take some ideas out of it, what I present tonight, add it into their trading plan. If you're not trading, it's to help you understand where to start to build a trading plan. The idea that we need it, and everyone will tell you that we need a trading plan. Everyone says that. It is simply a written down set of guidelines, set of rules if you like, or set of guidelines that you work to in the market. When I'm out on the road doing in workshops and things, I constantly overhear at morning tea and things that people would lament that they would love to be able to trade with like an institution with them, just hand us some money to trade with. The simple fact is that those guys up on the institutional desks do not trade without a plan. They have a working plan that they have to adhere to, and compliance oversees that they work to that plan. You are trading against them. And people approach the market in a haphazard way, believing that they can beat the market with some quasi view of the world, and they're basically playing against professionals. If you want to beat them, and it's not that hard to do, you need to act like a professional in the market, and the first place to start is a trading plan. So we'll look at choosing trading as a business rather than just some kind of hobby arrangement. So trading actually is a business. It has all of the same things to do as a business does. Whether you have a coffee shop or a hardware store or an office works thing, it's all business. In this game, the game is equities, options, futures, foreign exchange, and any other variations in the form of ETFs and warrants and interest rate derivatives and bonds, the whole thing. There is a myriad of markets to work with, and it's quite interesting watching over the last 20 years that in the late 90s, of course, everyone remembers it was all little tech stocks that on the back of the internet were the things to trade, and then that sort of fell over in 2000, 2001. Then it became options, big markets in options, everyone going to options workshops and things, and that kind of didn't work out, and then it went to CFDs, and the CFD market sort of grew and shrank, and now it's really become FX, and it's like we jump from one flower to the other without ever really investigating and working with something that might interest us in the background. It's quite tragic and it's quite a waste of time in the markets. Tonight's presentation is a broad overview of rule-based trading. On Wednesday, April the 6th, with Ivan Questions, we will be doing a series of 3 weeks which will drill down into the details of this, dramatically drill down into the details of this. And so this is a broad overview, and Ivan and I will take this apart in the next 3 weeks. Excuse me. So the thing here is that if price is the common denominator in the trader's success or failure, the price should be respected and understood. It's quite simple. There's nothing else other than that. If price is the denominator in your success or failure as a trader, then price should be understood, not the indicators. Anything around there, they're nice to have around, but price is the key in here. So the first rule we have is we understand price. A trader must understand the correlation of minor trends within major trends. So we identify the start of a trend. This is a little example I use in every single presentation I do. It is simply this little picture down here that there's a low in the price. The price moves up. The price comes back, pulls back a little bit, and then takes out a previous high. This little model here determines trend. There is no other method to determine trend. It is not moving averages. It is not anything to do with that. There is no textbook that will tell you that the trends are determined by moving averages. It is simply price. Price taking out a previous high. The buyer's willing to buy the market higher than someone has before. And this little model here, we keep this in mind. There's a high, a low, a lower high, and as we take out the previous low, we end up with a defined downtrend. And from there on, we don't know what's going to happen. It could simply continue down, and it could not. If you look at some of the stocks that are doing that at the moment, particularly the banks, and Woodside, for example, in broad, what we call a primary market, using weekly charts, is used to determine which way the trend is actually going. So within those trends, within those primary trends, we end up with these small trading areas here called secondary markets. This is the chop in the market inside a primary move of the market. This becomes the chop along the way as markets consolidate and wait for news or wait for Janet Yellen or something like that. Markets consolidate, and then if everything's right, the primary trend will either continue or it won't. So it's not a precise outcome and does depend on many factors, and we'll go into that in just a moment. This little example here, we have 3 charts here of three charts of the same thing. On here it has on the left a weekly chart, so we can see in the weekly chart, and I'll just get my little pointer out, there's been a low area down here, market moves into a high, comes in to make a higher low and makes a higher high. So we have this action of trend. Market comes back and makes an equal low, makes a higher high, makes a higher low, and ultimately a higher high in this case. And we can see if we break that down, these areas here become the secondary, what's called the secondary market, and then the primary move gets underway, and then often markets go back in to these secondary markets. And this is the part that actually rattles most traders. It makes most traders impatient. If we look at this area here on the top, at the top of this one, and come over here, this is the daily chart of this consolidation here, and we can see in the daily chart there's also a trend within that trend inside a daily time frame. So we're seeing this weekly time frame here broken down into this daily time frame. If we take a look inside here, over here, we have this hourly chart, and within the development of this day, this becomes the hourly chart down in here. So we have trends within trends. We can see in the hourly chart the trend is actually down. We can see in the daily chart the trend is up, and we can see in the weekly chart the trend is up. First tip here, if you're new to the markets, is find one of these going in the direction that you want to trade something. It is a key element in success of trading is to trade with a primary trend in place. All of the morning emails I put out, all of the trade recommendations I do, if you look into them, they have a primary trend behind them. If I publish a daily chart, they have a primary weekly trend behind them. This is the area where most traders, this is where the excitement starts and basically starts and stops. I've used this little graphic in a couple of presentations. This is simply what we might see at the entry of a trade. Down here we have a couple of indicators that have given us a bit of a buy signal on here. We have this larger range period here. This could be a daily chart, it could be a 5-minute chart, whatever we choose to do. But essentially it has a larger range here and a bit of support along the bottom here, larger range pop out, and for whatever reason that we choose, this becomes the trade that we want. This becomes the high probability that this will continue in the direction that we're anticipating. The thing around this picture is that there is not a single person in this webinar, and also I don't know, and there's not a single person on the planet that actually knows what's going to happen next. There's not a single one of us that knows where the market is going to open tomorrow. There's not a single one of us that knows where it's going to close. No one knows where BHP will be at 11:30 tomorrow morning. It is impossible to know. But somehow we build up expectations that we need an outcome from an entry, from a trade entry. If we step back from this a little bit and take the view that we actually don't know what's going to happen next. No one can possibly know, and if you think that I know, you really need to have a think again, because I simply don't know. It becomes what we call a game of numbers. It becomes a game of keeping your losses short, essentially managing your money on the risk side of the trade. It's not about picking winners, this game. It is simply not about picking winners. It is about looking after your risk on the downside. So whatever happens after this has to be a function of a trading plan. It has to be a function of a trading plan. It can't be you. It can't be your discretionary decision when you reach for another indicator or look for another time frame or send an email or something like that looking for confirmation about something. It has to be part of a trading plan. And so how could anybody possibly know what's going to happen next? It's simply impossible to know what's going to happen next, and I'll go into the reasoning behind that, in a bit more reasoning behind that in a moment. So this is good. Everything's worked out. So our trading plan looks at first of all, our entry and how we're going to manage the following data after our entry. Every single trading period has to be suitable within our trading plan along the way. In the portfolio that we ran at First Prudential Markets last year, it's still up on the website, and I encourage you to go, and we'll actually take a look at it in a moment, but it was simply this. We had one simple trading rule, one rule essentially in the whole thing, is a technical entry as a breakout or an engulfing candle at support. That's all I looked for, that one single thing. We had a bit of money management in there, that the margin was not to exceed 60% of GLV because it was a margin account, and the first stop was at the low of the decision day, and I want to talk about that a bit further as we go. So the entry day, and then which was essentially decision day, and if we went short, the first stop was at the high of the entry day on a short position. We had in that portfolio over a period of 11 months, we had 47 stop losses and 17 wins, and we ended up with a gain of 34%. It's simply a game of looking after your risk side of your trade. That is trading, looking after your risk side. It is not looking after your profitable side. Your profitable side will, the trades that go on will look after themselves. It has nothing to do with you. It is simply the market doing what the market does, both ways. And it's often traders find it very, very difficult to deal with the downside of the market, but they're more than willing to accept the upside of the market. And this is what creates the conflict. The current portfolio we have going is with $10,000, and it's with Matt Murphy's money. Matt's the director of FP, and he gave me $10,000 and said, knock yourself out. So in the true spirit of the game, so far we've taken 7 losses. We've had 3 wins in there. This is in the last 4 weeks. Last 4 weeks, as you know, the market's been quite soft, and currently we're down 5%. Same thing, we're using a trade size of 5% on our $10,000, essentially $500 of margin. So any position I create doesn't consume more than $500 of margin. It's been quite an interesting outcome. The little portfolio was down 18% a couple of weeks ago, and we cut out the losses. This is also on the website, available to anybody to see, and currently we're on our way back, and we're down 5%. It comes down to this little graphic here, and I'll show you this in a chart as we go a bit further on. But there's a trade in there at the moment where we took an entry at $4.07. This is today's candle, this last one here on the right hand side. We took an entry a few days ago at $4.07. This was in the afternoon right at this point here, and automatically the stop loss goes at the low. So we know what our risk is. Our risk is from the entry level to the stop loss. We know what that risk is. That risk is essentially $4.07 minus $3.84 is 23 cents. So I don't want to risk more than 5% of the portfolio if I have to take the stop loss. So that 23 cents gave us a position of 2,000 units, approximately 2,000 units. If we had to take a stop loss, we would generate a loss of $460, which would be 4.6% of the account. It's fixed. There's nothing else to worry about now. So the trade will either work or it won't work on here. As this, and hopefully we've had a reasonable day today, as this gets underway, hopefully gets underway up here, who knows, we'll start to bring our stop loss up and cover our risk in the bottom here. But it is this part here that determines whether you will succeed or fail at trading. This, I have observed this, I've been part of this myself. It is the determining factor in your success or failure as a trader, is your ability to manage the stop loss side of the trade. Whether you're in FX, whether you're in futures, whether you're in trading options, it doesn't matter. Ivan has provided me with this slide. This is just another example. I'm going to show you a couple of different ways here, but this is another example of what this is about. In this example here, for whatever reason, an entry was taken just here at 100, and the stop loss again was set at the low of that bar there, and the market in this case has moved on, and an exit taken here on the break as this period here moved down this low. So in this example, the stop loss is moved up underneath each period as they complete until eventually you're stopped out. So in this example here, the initial risk was 5 points or 5 units, and the initial profit on this move was 8 units here. And so it was closed here at 108, so it becomes 8 divided by 5, and we have what's called a 1.6 return against our risk. We made 1.6 times what we risked, 8 points on the reward against 5 points or 5 units of risk in there. So the reward becomes a factor of the risk in there as a way of managing accounts. So the beginning of a trading plan. I've got a couple of questions here. Do you tend to trade stocks that don't usually gap much? It doesn't matter because you don't know. Gaps can be a good thing. I struggle to trade things under 50 cents. That's one thing, because I find that end of the market is a little bit random. Having trouble with my exit strategy. Could you perhaps share your views on an exit strategy? I don't seem to maximize profits. A pullback at times halves my profit. Yep, welcome to trading. We'll take a look at that. What is the lowest time frame for you to trade? For me, here's the thing. I tend to look at daily charts, daily, weekly charts. In my work at FP, there is some work we're going to show you with Ivan. I'll give you a glimpse of tonight, some work I'm going to show you in multi-hour timeframes in there. But this comes out in workshops I do live as well. This is just not about me. This is about you. You should be asking yourself these questions. What's the best time frame for me? What's the best market for me? Can I stay up all night if I trade the US market? Can I manage the swings in a futures market? Can I manage the movements in an FX market? That type of thing. That's really the questions you would inwardly be asking yourself before you stepped up to the market in there. I was talking to, they might be here tonight, I was talking to someone that gave me a call yesterday. We were talking about trading and one thing and another, and I was explaining about the trading or trying to get across trading as a business, and I said to them, what do you do? And they said, well, they're in the army. And I said, well, that's great. I said, the first day you arrived, they gave you a gun and a 6-pack of grenades. Is that right? No. The first day you got a haircut. So the message was that there is as any business, you need to build your skill in the business. And we start off here, we start off this thing, building a trading plan. What are the running costs? What's my internet? Is my internet reliable enough for what I want to do? If you're trading, 3-minute charts on FX, do you have a continual internet line, or does your internet get interrupted, that type of thing? I'm doing this from home. I have a 50 megabit connection on the internet, and I can tell you it's pretty average for just as a factor of the internet itself. You need to understand the hours of the market, the spread costs, and the data feeds. I'll show you what this looks like. Bear with me. I'll show you what this looks like. It looks like this. This is a gold system that I'm working on. I have everything I need to know about this, about basically the gold market. It's the lot size is a 500-ounce lot. I understand that it's 10 cents is the minimum movement on there, which is essentially $50 a pip. The brokerage is $350 per 100,000 in this particular contract, $100,000 of value. It's a $43 round trip, which it equates to about 17 cents. The spread average is about 32 cents on 500 ounces. The spread is $160 alone. So there's quite a bit of ground to cover before you, I understand there's quite a bit of ground to cover before you actually make any money out of this. The contract opens at 9 a.m. Closes at 9 a.m. in the morning, reopens at 10 a.m. And this is a little bit skewed now because of daylight saving. I think it closes at 8 now. The opening candle starts at 8 a.m. and runs, I'm looking at a 3-hour time frame. The Asian Open is 11 a.m., the European Open is 7 p.m, and the US Open around 1 a.m. And down here, I'll go into this a bit later, but down here are basically the guidelines of what I'm looking for on there. So, it's this. It's as simple as that. Just write down what you're actually doing. So the risk and return of a trading account in here, there is this is another example here again. For whatever reason, if this is something that gets your attention, gets you to sit up to your trading account, maybe there's a gap away in here, maybe it's broken above this little resistance area in the back, whatever, maybe the indicators have given you a buy signal, and in this case your stop is here. So the entry at $7.16, the stop is at $6.80, you have 36 cents of risk. This is the part you must understand, is what your risk side of the trade is in there. In this example here, if your risk, your R value is 36 cents, so if the trade loses 36 cents, it becomes what's called a -1R. Now the 1R is, let me go back, it is this gap between your entry point and your stop loss is considered your risk. Your R value is considered 1R. So if the trade makes 36 cents profit, then you go to what's called a +1R profit. So you've made 36 cents against your risk of 36 cents, so it becomes a +1R. The trade makes a $2 profit, then it becomes simply $2 divided by your risk of 36 cents. Your factor becomes, the trade becomes a +5.5R value on there. Again, bear with me and I'll show you something about that. I won't go into detail on this, but I will go into detail on this with Ivan. This is a 3-hour chart. The sample is 400 bars and we're simply looking at an inside bar on there, and you'll see over here on the top right, there's R minus and R. So every single trade that was triggered down through there gave me an R outcome on there. So down the bottom, it produced a 28R profit with a 9.8 loss against there. So essentially about a 19R profit overall. There were 30 wins and 15 losses. Do you think I feel comfortable about this trading method? You don't have to answer that, that's fine. Okay, switch up. Okay, and it's based, all that sheet there is based around this this methodology here of when we create what's called a positive R expectancy of future trades. So it gives us some confidence to work with now that it will allow us to confidently take a position, and 2, it will allow us to confidently exit a position if we have to, because we know that if we destroy our R value, the overall trading plan is simply not going to work. In this example here, margin size, I've just used a margin account in this example. Margin account of 5%, 5,000 of 100,000. If your margin requirement is $1.06, it allows you to buy 4,716 units on there. Buy 36 cents gives you 1,700. The 36 cents of our original risk gives us $1,700 of risk in dollar value, and whatever that dollar value is simply becomes the R value, -1R. So if the trade goes to a loss, we end up down $1,700, 1.7% of the account. That needs to be decided whether that is acceptable or not. You can start to build a spreadsheet of this type of thing. I showed you, I did that mine on a Word document essentially, but you can build a spreadsheet on here, just a bit of a journal about your trade, what you're risking in there. As an example, if the trade returned 72 cents, it would be an R2 return. You won 2 times what you actually risked in the trade, and if it lost 72 cents, and if your stop loss was at 36 cents and it lost 72 cents, it would simply be a minus R2 for whatever reason. Could be a gap, could be news, could be anything. These things happen. It's simply registered as an R2 trade, and you start to build this database of information that you can look back on and keep building on, and look back on and say, I'm confident that this is my trading entry. I'm confident taking a stop on this particular position because I know that by back testing this works. As I won't go over this too many times, but Ivan and I are going to go into this in considerable detail over a 3-week period. So this is what it looks like in the scheme of things. This is what 47 losses and 17 wins looks like at the beginning in here. In this example here, and I've used this in a couple of workshops I know, but this example here, you can't get away from this. This is really what the institutional guys are measuring their performance against, is this type of thing where you have this 1R loss down here, loss of 1R, and a 1R loss, and the next trade comes in as a 3R winner, a 1R loss, a 1R loss, and a bit more down here, possibly 2R loss on here, slippage, whatever, and the next one comes in as a 4R winner and a 1R loss, and so on, and then another 1.5R win, another 4 or 5 win, I should say, another 3R win, 3R win, and so on. And it looks like this again. This is the model, the entry point. If this is the entry level up here, and our stop, we decide our stop is here, this becomes our R value. If our entry level is here at the top and we choose to put our stop at the bottom down here, this value becomes our R value, and whatever occurs on the upside, if there's an upside, becomes a factor of this value in here. So for example, if this value here is 20 cents, and this goes on and makes 20 cents and makes 20 cents and makes 20 cents, this becomes a 3R trade, 3 times what we risk. This is a numbers game, and comes down to this, simply comes down to this. Okay, so developing a trading plan and rules. Are there any questions right here? All good? Yeah. All good? Okay, all good. Should we factor in the costs of brokerage spread into the position size? Good question. Good question. At the end of the trade, whatever you end up with at the end will be a factor of what you risked. So in essence, it's already factored in to your position size, because otherwise you're anticipating, you're factoring in too much information into what might not happen in there. So if a trade is taken, whatever the exit is, if you don't get the exact exit position, or if you get better than your exit position, then the spread and everything comes into that. The R value comes into that at the end of the day. That's all it comes down to, is this R value. So to take on your question again, should we factor in the cost of brokerage into the spread? If brokerage is a factor of your trading, if brokerage becomes a major factor of your trading, we need to think about doing something else. It's kind of like the guy who owns a fruit shop that spends a day in the market and 50 miles away and comes back and sells $100 worth of fruit. It doesn't work. But the travel and the going to the market is part of his business. Okay, on the current portfolio that we're running, this is a snapshot of the current portfolio. Every day I put out trade ideas. They're all based around the same thing. I would ask that if you take a look at it and try it out, if you don't know where to start in building a plan, take a look at some of these ideas and see if they work for you. So as I said, we're still down about 5%. We've had a tough couple of weeks with that, but we've taken 7 losses, had 2 wins, and these 2 here, I've got 2 in green at the moment. That'll make it 4 if we close them out, and 8 losses if we're closed out this Santos one right here. But we'll see what occurs. In the coming days, and I'll go through these positions here. So we started with $10,000. We actually got it down to about 8,100 or something. It looked pretty sad there for a couple of days, and have simply let the winners run here, and they've come back, and our stops haven't been hit on there. So what's the game with this? This is really the question around this thing, is what's the game? The game is just simply managing risk. That is the game. It is not picking winners. It is not listening to what I say. It is not listening to ideas of some cheat sheet or something like that, and the nonsense. And I get my head on TV, but some of the stuff that goes on TV might be a bit questionable. But the game is about what's in front of you, and does it suit what you want to do in the marketplace. So trading can be as hard or as easy as you make it. The reality is that traders need to survive the learning curve to get an understanding of what works for them, not what works for me, what works for them, and how to approach the market. Along the way, you'll make mistakes, which is inevitable. You'll also be wrong. It's a sobering, but this is all part of the learning curve. As successful and improved traders prove that you can be successful in the market if you just learn from your mistakes, even if you are successful, continually learning from your mistakes. And if you grab hold of a institutional guy, they've got compliance looking over their shoulder all of the time, and they really are under quite a bit of pressure to cover not only their desk space, but make a dollar for the bank as well. So you can't do that willy-nilly. You need a plan to do that, and that's how they're quite successful. And there are 20 and 25-year veterans at trading desks. Use your own mistakes. Use your mistakes in your own self-advancement of trading success. The markets. This is why we can't understand what's happening in the next hour, let alone the next 24 hours in the market. The markets are made up of thousands of participants around the globe, both individual and corporate, each acting for their own reasons. There are reasons that people decide to unload positions, particularly inside institutions. If they decide they want to reduce their weighting on a particular stock, it's got nothing to do with what anybody else thinks. They just simply need to be out of that position by 4 p.m. and they just simply go to the market and sell it, and next day selling has stopped, and we wonder why things are down one day and up the next day. There are a myriad of reasons that the market moves up and down along the way, including news. The decisions made by these participants show up in the price movements of individual shares, futures and currencies in there. The futures market is hedged against the equities market, and often currencies are hedged against overseas portfolios as well. So there are a myriad of reasons. A lot of people suck up this story about the currency market being the most liquid, biggest market in the world. The retail side of currency is actually quite small. The institutional dealing side of currency, where countries pay for their goods and services in overseas in foreign currencies and take imports, that type of thing, that market is huge, and simply they've figured out a way to piggyback on the back of that and take advantage of those movements. It is the retail side of currencies is incredibly small inside this touted $4 trillion market a day thing. Just nonsense. So there is when you step back and consider what you're actually dealing with here, it brings things really into perspective. So as new information comes to the market via media reports or company-specific media releases, so individuals react to this information based on their own decision making. And you can see this really prevalent in the FX markets from time to time, and in the futures market as well from time to time. It is an interesting fact. While we've been chatting in this webinar, gold has moved some $5 in the last inside the last hour. and it's gone sideways for the last 12 hours and simply suddenly moved $5. As we don't know what is going to happen in the future, a trading plan is required to give a response to the coming future movements in price. So prediction is not a trading plan. This idea of predicting things, this concept that, oh, well, this could go here or this could go there is also a bit of nonsense. As it's prediction is not a trading plan in there. A trading plan is dealing with what's in front of you on your screen, and whether that's part of, whether what's occurring on your screen as your business as a trader, whether that suits your trading plan or not. Looking for the next best trading system will undo your long-term commitment. If you jump from flower to flower, and you'll waste 5 to 10 years of your life, it will undo your long-term commitment to this process of trading. Finding a rule-based system will put you on a road that really can't be deviated from along the way. So a trader must know why a strategy makes money. Why does it actually make money? Every day I publish a 60-day high in the morning newsletter. Why does that make money? Well, I'm going to show you in a moment why it does, but it's a simple strategy, and I can prove to you that it makes money. And I had I'll keep going. So we should be in sync with the market. So there is a little bit of understanding about the market sentiment itself. That can be found inside Indexes, and I'll just very quickly, want to go to our index. Just point out something here. Don't mind my interesting, the Bollinger Bands are squeezing in here. This is the daily chart of our index, and we can see today was quite a good day, but we can see over the past couple of weeks it was sideways up here and basically moved down. Today was an up day, today Thursday, Wednesday, Tuesday, and then last Friday, Monday, and so on. So it's been quite weak along here for whatever reason in there. And all I wanted to do was point out that while the index has been doing that, this little stock has been doing this. This stock's in the portfolio. I don't particularly care what the index is doing, but I really care what this stock is doing. And the reason it's in the portfolio is this breakout area. This is just a day chart. This breakout area right here, where it popped its head above this past resistance point back there, came up as on the 60-day scan. It has a higher low in here. It is inside a primary uptrend. I'll show you what it looks like here. It is part of a primary uptrend in there. Probability is strongly on my side that this trade will work. And if it doesn't, the stop loss is close by. Because as a factor of this stock, we can see in the past here, the stock has moved from $5 down to $3.80. I don't want to get involved with that if it starts to occur on this side. I don't know whether it's going to do that. I don't know whether it's going to go up or down, but it was a breakout, and often these breakouts either take off like this or they simply fail. The ones that fail I don't care about. We'll take them out, and the ones that work add to the bottom line in our account. Trading on leverage and margin can be very effective. As you know, FP Markets offers a margined CFD product. They also offer a non-margined CFD product as well. So trading on leverage with margin can be very effective or not. I just want to point out a couple of things that occur in this industry that you may not want to be a part of. If you take positions that are too big for your account, for example, if you use 50% of your margin on 50% or more of your margin on one position, you will fail at trading. You will blow up your account and you will fail at trading. This has been proven over and over. There is enough statistical evidence around to prove that large positions blow up trading accounts, particularly with margin. If you trade out of emotional need like ego or revenge, you will also fail. The market doesn't understand your ego or your revenge. You will fail at this. You cannot force the market along the way. Now, everyone's told you this along the way. I'm kind of reinforcing that. If you constantly try and catch a falling knife, you will fail. I had a big conversation today about this with someone at the lunchtime presentation. We're talking about this, constantly catching a falling knife, and you will fail. If you ask the Dick Smith holders and the Slater's holders and anyone else that's gone to zero that's trying to double up or catch the lows in the market, you will ultimately fail. If you double up on a falling price, you will fail. Now, I had a conversation with someone today about this, and they said, well, if you double up, often you can get your position back. And I said to them, if you've got that sort of information, send it to me and we'll have a look. I doubt it. Never seen it. There is a methodology, a high-end methodology for reducing positions in losing sizes. It needs to be back-tested. It needs to be worked and back-tested and found out. But essentially, if you're sitting on a position and it's not working for you, and you think that doubling up on any sort of bounce will work for you, you may get it right once or twice, but you'll ultimately fail. When you fail, it looks like this. This is the process that we go through. So the attributes of trading is not related to anything else we do in our daily lives. The attributes required to step up to a trading account and to trade in the markets are not related to anything that we do in our daily lives. We conduct our daily lives very differently than what the market requires. So trading with a single thought, we basically need to trade with a single thought. And that single thought is to manage the risk of our trade. It looks like this. On the top left-hand side here, where we may do the work and the investigation and take some action in entering a trade position. And along the way, we monitor our progress, and then we get the results and its implications. And down here on the right, that we come to a point where we ask ourselves, was the result as we expected? That answer is either yes or no. And it's often tragic that the result as we expected was actually a long time ago, and often people let that period pass and it ends up as an emotional exit. But if the answer was yes, there's no action required and you feel pretty good about the whole thing. If the answer was no, we go into, and I've been here, we go into this process about how upset, and how the first reaction is, how do you manipulate this to change the outcome? Now, this is the market. You can't change anything in the market. And often thoughts about who didn't do their job, where did I get the information, who can I blame, who created the situation where it failed, and what can I do, or who can I call, text or email, or whatever. And if you think about it in day-to-day living, if you leave something on the kitchen bench and it goes off, we can blame someone for that. Who left this out? Who left the fridge door open? That type of thing. If the car runs out of petrol, who didn't fill up the car with petrol? And we can get all these things fixed. In the market, you pay for your mistakes. You pay for the ones that don't work. It's just a cost of doing business, simple as that. You can't go into this area here the market has already moved on and really is offering you another opportunity in there as well. So we'll take a look. What I wanted to look at was developing up trading plan rules. So Van Tharp said the most successful market professionals achieve success by controlling risk. This is all the professional traders talk about, is controlling their risk. Controlling risk goes against our natural tendencies. Risk control requires tremendous internal control. Okay, so what that looks like here on the, and I would encourage you to have a look at this on the website. Here we have, this goes up on the website every day. We're using, this is the portfolio that we've got, this is the current snapshot today of where we are, the positions that we've got, the comments. I keep a bit of a journal about what I'm thinking. I made a mistake, one mistake on MND, a trade we had in there. It should have triggered earlier, it was my error. We're still in drawdown on the account. So we've taken 7 losses and 2 wins so far, and we've got another 2 in profit right there. So the 7 losses, we've taken 7 losses, only 2 wins, and these 2 trades are in profit, and we're only down 5%. It's not a bad outcome in a soft market. So these, I'm quite confident with where these are going. We'll see how they go in the next couple of days, and if we need to exit, we will. So there's some notes here. This is the actual trading plan down here. It is written down. The position sizing method. There's 2 methods in here to position size. One is the textbook method, and one is just a method I use in this little portfolio. The textbook method is recommended, and down the bottom I have the wins and losses in here. Stopped out, stopped out, stopped out, stopped out. We took profit on this one, took profit on there, took profit on here. This was basically a break even with a dividend, and these open trades down here. When you go down a bit further, you'll find the each trade that was taken, you'll find a chart with a reasoning behind it. And currently we're in the Santos position here. Now this is what it looks like on the chart here inside the little portfolio I've got. The ACX trade there, you can see this was a reasoning here. We got into this at 5.36. Recently it was 6.31. I think it went to 6.37 today or something. But that was the reasoning. It was this little breakout here. That's all it needs. I'm not interested in this noise in the background, just this little breakout in here. Now I'll come back to this in my chart here. The Santos one, I just want to go through the Santos example again just to show you what this looks like in the thinking. For whatever reason, we've taken a Santos trade. Just want to bring this up a bit closer. Sorry. Come on. Bring this up a bit closer here. Sorry. Get this out here. There we go. That's what I want. Okay. So this day here, a lot of noise in the background on this. This is the day chart. A lot of noise in the background here. And suddenly we had this basically an engulfing day here that took out this previous body here. But when you look across, the closing price looked like it was going to close up here. The trade was ended at $4.04. So already we had our entry price, and we knew where our stop loss was at the low of this day, around 384. And the reasoning is that this day was starting to trade up and looked like it was going to close above all of these areas in the background. So not a bad look to start off with. In the background, as I said, there is the weekly chart of Santos, and you can see that there's been in a broad downtrend in there, broad downtrend down through here. But something really interesting has happened on this side, in as much as we've had this spike low, oops, not that one, sorry, this spike low down the bottom here, and this really little secondary market in here, and then this major push on the weekly chart. And this was 4 or 5 weeks ago, major push above all of this noise in here, and these small bodied candles here all rising and pushing in this tiny little ascending pattern right here. So the trade was taken when this was basically sticking up through the top up there. So I've got a little bit of evidence here that this trend is starting to reverse. So it is as simple as this, that the entry was 404, the stop loss is 384. If I risk 23 cents on the trade, my position size is 2,000 units. The most I can lose on this is $460, which is 4.6% of the account. Now, someone said that 4.6 is a large position in the account. Yes, it is. I agree with that, and I'm not suggesting that I'm not recommending 4.6%. The account was there to be traded as an aggressive account. So 4.6% is, in this case, was just simply a decision that we made. Usually this runs at around about 1 to 2% of your account size. You really don't want to take out more than 1 to 2% of your account on a losing position. So this, getting back to our R value, this 23 cents becomes our R value. So whatever occurs after this point, if the trade goes on, hopefully it does, then whatever occurs becomes a factor of this 23 cents in there. So, having said all of that, are there any questions? So I'm going to finish up in just a minute. For STO trade, what is your take on the weekly? Should discuss further. I did that, yep, got that. Can you compound on the next bar? Is it allowed for your R? The answer is no. Compounding, if you, let me see if I can talk this out. If you compound out on, the answer is no. If you can prove that it works, the answer is yes. Let's put it that way. If you can prove it yourself, it doesn't work for me. I just know in my view of the world it doesn't work for me. In your webinar box there's a little handout section there that you can download a document called Ivan DNA PDF, and that is a discussion around your DNA and the market's DNA. You're matching up the two, matching up yourself with the market where the best fit is. As I said, we'll be doing 3 weeks of workshops next month, or next month tomorrow, with Ivan on FX and futures trading. SX trade was taken on the 16th of 3rd. Portfolio was updated on the 29th of 3rd. Any reason for the delay? That was the ACX trade was in there on the 16th of 3rd. I probably didn't publish it till the 29th because I was on holidays. And believe me, I watched it every day while I was on holidays. How would you move stops on this trade? Good question. All good, thanks. Okay, so a couple of things. Let's go with the ACX trades, nice and easy to look at. When we look at this is the weekly chart of ACX. The trade was taken in here, this little bar there. That was the bar was off the back of this pullback. The sellers have exhausted themselves, and the buyers have come back in, and it's poked itself above this. The closing price has poked itself above this resistance in here, and since then it's followed through. This is interesting this week that it has this type of candle up here, and this may be a reversal candle. And I would get very interested in this if on the week, now that this trade is underway, on the weekly basis, if it came down and traded below this 606 level, which is the low of the week. What I'm interested in this portfolio and in this type of thing, what I'm very interested in is this, capturing these large moves in there. It is what produced the most success in last year's portfolio. We had 47 losses and only 17 wins, and we're up 37%. And it's because the winners were huge. The losses were a couple of $100 here and there and $1,000. The winners were $8,000, $10,000 and $12,000 on the winning side. So I'm looking to do that here at the same time. Really don't want to put my thoughts onto the market. So 606 is essentially this area down here. If it breaks this low here, closes below this low here, I would be looking for an exit out of there. But you can see the other method of this. Is that, as we said, the initial stop loss goes underneath the entry day's price, and it's not that hard to move that up every day underneath the low in there. Nearly got stopped there, underneath the low, and would have been taken out on excuse me, on Wednesday as it took out this low in here. Now let me clarify that before I get too many emails about it. Down in the notes here, am I on the right one? Yep. Sorry, down in the notes here, The first stop is at the closing price at or below the low of the decision day. So if taking a long positions, stops never go backwards but can change. What it essentially means, and it's in here somewhere else as well, is that the stop is taken at the close of the day. So we avoid getting spiked out. Often during the day, prices can move through your stop loss and then recover in the afternoon. Now there is a note in the portfolio about that, that the stop loss may be a little larger than what you had put in there. That's just a factor of what we've decided to do. But the entries are done at the end of the day and stops are taken at the end of the day as well. And everyone's seen it. Often we get stopped out way too early on there. So that is on the portfolio as well. Now, very quickly before I go, I was talking about the 60-day high. Just as an example of this would be, you can pencil these down. This is today's list of 60-day highs. And the reasoning for 60-day highs, this is what Astro Jap Prop Group something. This comes up every day on the scan. And it broke back here. In there, it broke here at basically $5.97 and now it's $6.31. It has a trend behind it. It has this secondary market that we talked about and then a break into the primary trend. So very simple concept about trend. So you would not put a stop in to trigger that. No, I don't, but I do set an alarm in there. Now, if it stops continuing audit market or price, if it's a thin market and go through your stop and don't fully liquidate, that's correct. Yeah, so you set a stop as a contingent order at market, or if you set it at a limit price. The point is, if bids are thin, the market can go through your stop and you don't fully liquidate. The proper answer to that is you should never hold a position that you can't get out of, basically in one level of market bid. There are many small stocks where if you hold that only trade 40 or 50,000 units a day, like this one here trades 64,000 units in here, and if you hold a position bigger, and let me put the volume up here. So today's volume was, the average volume here is around 75,000 units, and I'll get a market depth out. If you take a position, so keeping in mind this is after hours, okay, so there's no us there, of course. If you take a position, a 10,000 unit position, which is essentially 20% of the day's volume, it can be awful getting out. You can sit there and wait for it, but if you need to get out in a hurry, there's a crush at the door. You really don't want to hold more than 2 to 3% of the average daily volume. So in very liquid stocks, it's not a big issue, but in these small stocks, it is a very big issue. On the 60-day high, for example, this one here, APN, oops, sorry, got my people ask me about these things and I leave them on the charts. There we go. So again, this stock here, this came up here on the 60-day high a few days ago. It's come up again today. We have this consolidation in the background. A jump out of here would have come up here. If you look at the way that this stock actually trades, from this sort of trading range in here from 54 cents to 45 cents is essentially a 20% trading range of price movement in here, and here again up here 62 to 54 is probably 15 to 17% of price action in here. So this taking stops early is a great idea on breakouts. So if this came up as a breakout trade, the entry point would simply be at today's close and the stop loss would be at today's low, and that's the end of the chat. It's so simple as that, and with the view that you'll either get stopped early or the trade will continue on in there. Another one, this is the list here. I don't think there's anything too interesting in here. Fletcher Building, this has been everywhere. This is the daily chart. You can see this is quite a mess. This probably wouldn't interest me all that much. This little stock here, very thin again, been very big in the last few days on this breakout, but very constricted down through here. Wouldn't interest me at all. I don't lose any sleep over this type of movement. The other one that was a little interesting was this SSM service stream. Trend is in place. There's been a breakout every now and again. Breakout, consolidation. If you come back in here, consolidation, breakout, consolidation, breakdown, break up, consolidation, break up, consolidation, a little bit of down movement, strong move up again, consolidation, breakout, consolidation, now a breakout. So at best we would expect some consolidation here as part of the price action on this. But this would look interesting to me. It's over 50 cents and it's basically a breakout on there. The other one is Pacific Brands. Bit messy up through here. Looks like it's a bit of a struggle to get up through here. This probably wouldn't interest me all that much. This breakout here would have. So this becomes, all I'm doing here is sort of explaining my trading plan. I would encourage you to go and get your own trading plan. When we talk about, when we get to Ivan's, the tutorial I'm doing with Ivan in the next 3 weeks, it is going to get into very specifics, bar by bar analysis here. I really want to just open up the door here to looking at trend and the broader market in its place. Someone's put a note here. Yeah, what's that one? AHG. So someone's got AHG continuation wedge to 460. Okay, we shall see. AHG. So let's continuation wedge to 460. Maybe bit of work to do, but you've got no evidence that this could actually. Let me go here. Sorry, I need to go back this way. The comment was continuation wedge to 460, but you actually have no evidence. You simply, be a bit clear about it, you have no evidence. You have no breakout. This could simply continue to wander down through here, down to the right. It could break out tomorrow and could break out tomorrow, but it's a stock that's trading sideways. It's still in a trading range. It has a low probability outcome. When you look at the probability of 60-day breakouts, if you go through this list, you will find that a lot of these stocks have been on that list for several days, and you'll find that there is a high probability of a breakout continuing from 60 days. I've just picked 60 days, but 60 days seems to be a workable number. This is the sort of thing that we're looking for. Today, Medibank Private broke out. It has a trend behind it, primary move, trend, primary move, primary move, consolidation, and we're back into the primary move. This sort of stuff has high probability outcome in here. It should be part of your trading plan, whether it's on the way up or on the way down. This is the weekly chart here. The other one that we put a short recommendation out was Bendigo Bank. The primary downtrend is already in place and looks to be continuing here so far. It could change quite easily, but looks to be continuing so far. So that's the best we can do. And we take the stops as we need to, and the rest. So I'll finish there. I want to thank everyone for being here for this long. FP Markets have an offer for you that they would like me to read out. If you're not an FP Markets client, we certainly invite you to be an FP Markets client. If you open an account before April the 8th, on there, I'll bring this up a bit. If you open an account before April the 8th, will offer you 8 basis points brokerage. Usually that's reserved for accounts over $50,000, but they'll allow it for down to an account of $1,000 on there. You'll also receive a series of trading packs on some tutorials, some more in-depth tutorials, and access to the daily market report, which I put out every morning, and which has a trade idea in there every day as well. You will have access to the portfolio, so you can keep an eye on me, keeping in mind that I have the boss's money, and you have access to my Monday morning weekly chat. Is done at 9:30 on Monday morning. We consistently get over 200 people in that room every Monday. It's been such a success. It's been terrific. If you'd like to receive all of this, if you fill out an application, in the promo code, if you could drop in this text here in red, GB trading plan, into the promo code or who referred you, and this will automatically get filled in. Question here, where did I mention the Ben short? It was on the daily morning newsletter 2 days ago, I think. Okay. Now before I go, let me go right back up here, and I'll turn this off in a second and have a chat. I just need to point out this education material is prepared for general guidance only, does not constitute financial product advice or does take into account your investment objectives. So please see a licensed advisor before acting on information you may see or hear. And thank you so much again for coming out.